Hello, good morning, good afternoon, good evening, whatever time you're joining us today. Thank you for checking in with this webinar series. Today, we're going to go over how to invest in apartment syndications. My name is Corey Daharsh, and I'm joined by special guests Richard Coyne and Bill Zahller of Park Capital Partners. So again, I've got Richard and Bill of Park Capital Partners. They have been multifamily syndicators up in the Western North Carolina region for the past 4 or 5 years. They partnered together after meeting at our local RIA group and have been doing excellent deals ever since. Richard, Bill, do you have any additional aspects of your bio or background you'd like to pitch in? I just figured I'd give you a softball pitch right into what you guys specialize in.
Yeah, thanks, Corey. Certainly, we're very glad to be here and really pleased to be able to spend some time with you folks. And happy to take any questions along the way, as well as at the end, we'll put our contact information up on the screen again. And certainly, please feel free to reach out.
Yeah, absolutely. From Bill, yeah, absolutely appreciate you putting this on, Corey. Glad to be here and glad to answer any questions. And we'll get into a little more of our background on the slide presentation as we go.
Perfect. Well, I appreciate you both being here. Little known fact, Richard and Bill were one of the first real estate investment groups that I found when I moved up to this region. And I've been actively visiting their investor group in the area since I moved up here and have always found it very educational and helpful. So I thought it would only be proper to have them join in and share some of their knowledge and expertise to the Advanta network of investors as well. So very happy to have both of you. Thank you again so much. And a little bit about Advanta in general. We are a self-directed IRA administrator. We've been in the industry for over 20 years. We have just under $2 billion in assets under management. And one of the things that sets us aside from our competitors is that we pair every client with a dedicated client account manager that will be your personal liaison to any investments you like to make, questions you have about the rules and regulations of retirement account investing. And that's just something that most of our other companies in this space do not have. So we pair that with this high level of education that we try to bring to our investors and our network to stand us aside from any other companies in this industry of self-directed retirement investing. And what is a self-directed IRA? If you're not completely familiar, a self-directed retirement account is really an account that allows you to invest into anything that you see fitting, not specifically the designated products that a larger wirehouse may deem as allowable for you, but really anything that is not a life insurance policy or what the IRS would deem to be a hard to value collectible are allowed to be held within a retirement account. Now, I've got a few alternative assets listed here. What Richard and Bill specialize in, again, is going to be private placements in the multifamily syndication sector. So we are specifically going to focus on that style of investment throughout today's webinar. If you've not heard about self-direction, that's perfectly fine. A lot of people have not. It's because most of those larger custodians would prefer that you only really know about the offerings that they allow, or in their quote, self-directed capacity, allowing you to choose from items and investments that they've vetted out. But the IRS does allow a much broader range, as I just mentioned on that last slide. And more specifically, only about 4% of retirement accounts across the country are self-directed. You can self-direct a number of different plan options, whether it be a traditional account, a Roth IRA, SEP and simple IRAs, health savings and education savings plan. And specifically, the former employer plans is an area that we see a lot of people move over from. If you've left a government job or maybe a teaching job in the local school system, those old 401k plans are typically sitting after you've left that employment, not really doing much for you. So it's a great source of capital that you can move over to a self-directed account and start really driving your investments and your portfolio exactly as you want that to grow. And again, another reason why retirement funds are a good source of capital for investing, sometimes you are able to get better returns than what you otherwise would just have your money sitting in, like a money market account or a CD for a number of years. Investors often end up not needing to access their funds because they're not going to retire for a while. So it's a good way to put your funds to use in a syndication or an other longer term investment to drive a higher return. And also, you don't need any outside approval. You as the account holder are basically the decision maker for your account. We are not fiduciaries, tax advisors, legal advisors. So we do implore you to do your own due diligence for any investments you make. And once you have made an investment, if it's a great deal and it worked out well for you, it's very simple to reinvest either with the same syndicator or into another piece of real estate, whatever it may be. The process of redeploying funds into a similar or the same investment after you've made one is very simple in the self-directed industry and space. Now, it is very important to specifically invest with people that you know. Always use your network. So network in your community, in your investor spheres that you found online throughout COVID, and make sure you're doing your due diligence so that when you're actually ready to place an investment, you've got a lot of confidence that it will be successful and that you've done all the vetting you needed to do before entering into that deal. And again, a final word on that disclaimer: Advanta and its employees do not provide any investment advice or endorse any products. All the materials that we are going to go over today are for educational purposes, and we always implore you to consult your own team of attorneys, accountants, financial advisors before making any investment and as part of your due diligence on the investments you would like to make. It's very simple to go over the rules of self-directed investing. As I mentioned much earlier, life insurance policies are not allowed, as well as collectibles or anything the IRS would deem to have a hard to value or a subjective valuation. There are some precious metals allowed. Typically, currently circulating coins are not something that you would invest into, but you can do a lot of other types of precious metals, and you can feel free to consult either our website or myself directly if you have questions about that. And the only other thing the IRS does to restrict retirement account investing is limit disqualified persons from investments with you. So that is to say, you can't buy a house from your children or your parents or your spouse or vice versa. Disqualified persons basically boil down to anyone on your lineal, descendant, or ascendant tree. And that, as you see here on this slide, is pretty much what the IRS does to restrict retirement account investments. And aside from that, it's an open market to invest as you see fit, with whom you see fit, under your own proper guidance and due diligence again. I've got a very quick case study, and then we're going to go ahead and turn the floor over to Bill and Richard. So my case study here is specifically investing into a syndication. So this process is just a streamlined version of what it would take to invest with someone like Park Capital Partners when you find a deal that you're looking to get into. So in my scenario here, I've got investor Abel and investment sponsor John. Abel's got over $50,000 in an IRA at a larger custodian. He meets John, who's got a private offering to purchase a local apartment building, and John provides Abel with the paperwork and lets him know that the minimum investment is $50,000. If you're new to syndication or real estate investing, that is a pretty standard minimum investment range. It may be lower, it may be higher, depending on the deal you're speccing out, but it is just a standard that I wanted to throw in here for a general rule of thumb. And in this case, Abel has decided to move forward with a $50,000 investment. He opens an Advanta account, completes a transfer form to get that $50,000 moved from his Vanguard to his Advanta account, and submits that paperwork to Advanta, specifically that client account manager I referenced, who will then process the paperwork to get the money moved over. And then the investment process in itself is just that the private placement paperwork would be sent to Advanta. Abel's account manager will make sure that the proper name of Abel's Advanta account is listed, and also the trust tax ID for the account, not Abel's social security number, for proper tax and record keeping. And then the investment would be funded by way of the account manager with Abel's authorization and approval. Moving forward with this investment, John's paying out an 8% preferred distribution to all subscribers, so Abel earns $4,000 per year on his investment. And in the 5th year, he receives a lump sum payoff after the project's refinanced of $65,000. So in total, over a course of 5 years, Abel's IRA has earned $20,000 in preferred distributions plus the profit at the end. And that money is either tax deferred, meaning it's grown within a traditional account and can continue to grow until Abel needs to take that money out as distribution. Or if it's a Roth IRA, all of those earnings are actually tax-free and not subject to any further taxation on the way out because the Roth account has already been taxed. Now, you might be sitting here thinking to yourself, okay, am I a passive investor in the scenario I just outlined, or more of an active investor with my current strategy and interests? So an active investor is someone that's actually seeking to do rental real estate or rehabs or wholesaling properties within their account. The benefits to that is there's a little bit more control, they're making the decisions, and it's way more hands-on, but it is a lot more time consuming and a lot heavier responsibility on you. Whereas the other option of being a passive investor would be investing into private placements, syndications, or hard money lending. There's not as much time commitment. You're not bothered by the day-to-day operations of the active style investments, and it's really just generating mailbox money for you. The cons are that you typically don't have direct control of everything, and you don't have any say in most cases in the decision making, but you are able to spec out and vet the investment so that you trust the people that do have those specific positions and are making those decisions. And again, with this slide being over, I'm going to go ahead and turn over to our syndicator experts who can get a little bit more in depth on how they handle passive investments and what you should look for and how you should proceed with any investments that you're looking to make. So thank you for my time. And with that, I'm going to make Mr. Richard Coyne the presenter and let these gentlemen take off.
Thank you so much, Corey. We greatly appreciate, again, everybody's time and joining us today. And just want to confirm that you're seeing the slide.
Yep, we are seeing the full screen version of your first slide. Real quick, let me just add, if anyone has any questions as these gentlemen are going, please feel free to drop them into the question box. I will interject and ask Richard and Bill your questions as we go so that they can answer them in real time as they're going through the materials. So please go ahead and drop those in the question box. I will be monitoring and interjecting with those questions as we go. Sorry, and thank you, Richard.
Absolutely. No, thank you very much, Corey. Again, appreciate everybody's time today. Thank you for joining us. Thank you, Corey, for having us. Again, just a quick note, Park Capital Partners will tell you about us, and I'll show the agenda in just a moment. But again, just as a quick reminder, we don't provide tax or legal advice. We're happy to answer any questions for you, but we strongly basically advise that you consult your appropriate accounting, tax, and legal advisors as you find out more about being perhaps part of an investment. Okay, here's our quick agenda. We're going to briefly introduce ourselves, just who Park Capital Partners is. Again, just to give you a little context. We'll talk briefly about why real estate. We'll touch on what a syndication is. Next, we'll cover what you can expect when you're involved in an investment, what to look for in a sponsor, a company like Park Capital Partners that does deals like this, and we'll then touch base on a few success stories. Okay. Bill?
Great, thanks, Richard. And thanks, Corey. Appreciate the opportunity. So just a quick little background, like Richard said, who Park Capital Partners is. Oh, can you go back? There we go.
Yeah.
One slide. Yeah. So Park Capital Partners, we're a real estate investment boutique that specializes in sourcing multifamily value add deals. And what that means, the value add is it's a stabilized asset already. It's not like totally going in gutting something that's 20% occupied and having to release it up. They're stabilized performing assets on day one. We go in and they haven't been renovated, say in 20 years, 15 years. We go in and renovate new lighting, new flooring, kitchens, that kind of thing. So light value add, probably spend between $5,000 to $10,000 per unit on average on that. And by that allows us to grow the rent, which grows the NOI, which creates the value for our investors. We were founded in 2016 as a company, Park Capital Partners, bring over 38 years of combined experience in real estate investing with combined transactional value of our team of over $1.6 billion. Like I said, we have I've been personally investing since 2003 in real estate and many different areas of it. So we formed the company in 2016 to do the syndication route, which we're offering today. Thanks, Richard. So our strategy, as I briefly touched on this, Park Capital Partner strategy is the value add plan. There's core plus, value add, and then opportunity like ground up development. So we think ours is on that continuum of risk and reward. We think it has the best combination. There's lower risk and higher reward, where like ground up development would have the highest reward, but also has the highest risk. It's hard to predict what's going to happen 2 years into the future if you break ground today on a project. As you come toward completion, we don't know what the economy is going to be doing or anything else, or other things that have come to market. On the core plus, those are typically a little higher price, closer to city center, business districts. A lot of pension funds will invest in those. Very safe, very secure, but much lower returns. And that's okay if that's the market they're looking for. They're only looking to get 5-6% cash on cash return. It's a good option for them. But what we want to do is be able to create the value and force the appreciation to kind of compress time on our holdings. So that's kind of why we've focused on the value add strategy. And what we look for in our criteria when we select a property is look for 1985 or newer. So typically between 1985 and a 2015 asset is where we're going to look that has some kind of value add component. It could be mismanagement, we can improve the management, or it can be, like I said earlier, we go in and improve the actual units themselves. We improve the grounds. We do value add strategies as like for some of the water savings program. There's examples of that. We can force appreciation that way too. And we were typically focused in the Southeast United States. Atlanta, Greenville, Charlotte, Raleigh-Durham Research Triangle area is where most of our focus is, and look between 100 and 300 units. And the advantage of that particular unit size count is below 100, we start losing efficiency of operation. Just as a good rule of thumb, basically every 50 units, you can have one full-time person. So at a minimum 100, we can have 2 full-time employees, the property will support, which would be one inside the leasing office and one outside doing maintenance. So that's kind of where we're going to, and you start getting over 300, that would support 6 full-time people. But anything you start getting over that and you start getting into much larger institutional players chasing those deals. So we kind of found the sweet spot between 1 to 300 units. And we're looking for suburban markets. We're not looking for center city, like I mentioned before, or really startup. We want something that has an established market with strong growth fundamentals, multiple different diversity on as far as jobs. We don't want just one industry. We want to make sure no one employer, like Houston, we use an example of oil back in the 80s. There was, like 35-40% of the entire market. And once oil tanked, then obviously there's a huge problem. So we want to make sure no one industry accounts for more than 20% of the jobs in the market we like. And then we're also looking for garden and townhome style apartments, not high rise. And then also stabilized asset, like I mentioned before. So it's already the definition according to the agency debt, the Fannie and Freddie would require 90% occupancy within the last 90 days, 85 economic occupancy. So they're already stabilized, they're performing assets. We just go in there and tweak it with our business plan and make them better. So we think we mitigate the risk on that side also. All right.
This is what, Richard, just one thing to add. And you might be wondering the age. We typically want to look at these assets, 1985 or newer, as Bill said, for the reason being that they, obviously are employing modern construction techniques, and we're typically not going to run into any concerns about asbestos or lead-based paint or polybutylene piping, things like that could very well be a problem down the road. So that's generally why we look at that type of an age criteria. So, okay, we'll keep going. There we go. So why real estate? Hopefully through your own investigation and education and attending sessions like Corey's putting on today, you've learned some of these things, and so hopefully some of this is a recap rather than brand new information. If it's brand new information, that's great. And again, we're always in the learning mode ourselves, and that's why we're happy to do sessions like this to help folks learn. And we run 2 monthly meetings, which Corey mentioned earlier. And again, for the purpose we do that for the purpose of helping others learn. But again, hopefully some of this already. Typical advantages of real estate, there are many, but we try to highlight a few here. And first of all, cash flow. When you invest in a real estate project, you're going to be, unless you're buying land that's going to sit there and be idle until you find its best use, we look at apartments, and apartments are it's an up and running functioning business today. We're buying a business when we buy an apartment building, so it is generating cash right away. Again, Bill mentioned earlier, we're buying stabilized assets that are typically have occupancies in a 90% plus range, and so they're producing cash right now. Over time, part of our strategy is to exercise the value add strategy approach, where we improve the properties and we find efficiencies in the expenses and things like that, and that will help us grow the cash flow over time. Out of the cash flow, of course, is where we make the investor returns, as well as, of course, pay the mortgage and things like that, and taxes and insurance and whatnot. But again, you got cash flow today, and you're going to grow your cash flow over time. The leverage is a super important point. Again, hopefully you know this, but if you wanted to invest in buy stocks, you want to buy 100,000. Just say you have $100,000 to deploy. You're gonna go out and you're gonna buy $100,000 worth of stock. But if you have $100,000 to work with, by getting a bank loan, the bank becomes your partner on that deal. You might very well be able to buy a $500,000 asset for $100,000. That's 20% down. If you try to get leverage on that type of an arrangement with stocks, you're not going to get a bank to lend you money to buy stocks. Now, you might be able to go on margin at the brokerage house, but again, that's a whole nother conversation. That's a whole other level of risk that you may or may not want to take. But typically, we find that the leverage component of being able to borrow money from a bank, from a national lender, or from one of the lending agencies, Fannie Mae, Freddie Mac, et cetera, to do these type of real estate transactions just multiplies the effect of the money. And when you invest in an apartment deal, you're also able to take advantage of that multiplier effect. Again, you bring $10 million together from multiple investors. You might be looking at, let's see, 20%. So you're looking at an asset that's, somewhere in 20, 30, $40 million range, depending upon obviously the level of investment that we're pulling together. So again, by being part of a syndication, and Bill will talk about that in a minute, by being part of a syndication, you're buying an asset that you or I might not normally be able to buy. So that's the power of leverage. We also find that, especially today with the printing press running at the Fed, that an actual real estate is an actual real tangible asset. It's something you can touch, something you can go and see, something you can drive by, something that is providing and sourcing a need that somebody has, and that is for a place to live. We find that it's a great hedge against inflation. In the fact that the asset will continue to appreciate, and the rents that you charge on those for the apartments, etc., will essentially ratchet up with as the inflation rate goes up. So you're typically going to be still able to track and move up over time, and for that reason, again, it's just a great hedge against inflation. The property itself hopefully will continue to appreciate over time. It's an asset that should be worth more in the future, barring catastrophic events or something like that. The asset should be worth more down the road. And again, obviously, that about your house. Typically, your house is worth more over time, et cetera, as well. And again, there may very well be some tax advantages for being part of a real estate transaction. So, obviously, I want to make sure that when you're using your self-directed IRA, there are rules, and you have to be careful about that. And that's something that Corey and his team will help you stay on the right side of those rules. And again, of course, we strongly advise that you talk to your tax advisor about how this best works for you. But again, there could very well be some tax advantages for investing in real estate. For these reasons and more, is why we love real estate, and why we invest in real estate ourselves, and why we do this type of a business. So we'll go ahead and keep on going.
Yeah, one thing, Richard, before you change real quick, I just want to touch on cash flows. Richard said that, if you think of it this way too, like in stocks, you invest in Apple or some company, you have no control, obviously, over the future plans. You're betting on it being a winner in the future and producing similar returns to the past. A little in the cash flow, like some of the deals, the A shares, B shares, they're structured different depending on deals, but a 10% cash yield, you're basically taking risk off the table every month, right? You're getting return on your capital every month. And also, if you compare that to what's currently out there as far as yield, the 10-year today is 1.285, which, I mean, it's below the rate of inflation. So you're net losing purchasing power, every year if you're invested in the 10-year. But also that prices, where I'm getting with the leverage on this, it prices to where we get debt at. So we're actually sizing debt currently sub 3%. So it's a phenomenal time to be a borrower. And as Richard said, as they're printing more and more money, the trillions have gone recently in the last 18 months into the economy as the velocity of money, continues, and it creates inflation. It can index for that. We have fixed rates, and they're locked sub 3% on the money. And then as we grow that creates quite a delta between what we're having to pay for capital and what we're able to charge. So I just wanted to point that out as far as the leverage side of it. It's a pretty golden time to be a borrower.
Absolutely.
Okay, so what is syndication? We'll kind of go with the textbook definition in a little clearer version, but it's a temporary alliance of all parties that join together and manage a large transaction, which would be difficult or impossible if affected individually. So basically, it's a group of individuals that pool their money to buy a large property. So if we were taking down a $60 million property, which typically a third of that would be what you'd raise in equity. You'd raise $20 million, and you'd take on a senior note for $40 million. So most people wouldn't have the ability to, write a check for $40 million. So we syndicate like-minded people to go into an asset, and we syndicate that, and it's typically they're one asset. The LLC is formed to buy this 123 Main Street, and then that's the syndication that everybody's involved in. And it's highly regulated by the Security Exchange Commission, and everything is spelled out, and there's a lot of boilerplate. Scary reading on any of those, but the syndication is memorialized in a document called the PPM, or the Private Placement Memorandum, and it spells out everything on the terms, what to expect, what's allowed, what everybody's agreeing to. And then, like I said, the PPM, there'd be that with an operating agreement, and a subscription agreement too would kind of constitute how that property is run, and everybody has, it's very clear going in what the parameters that would be. One thing to note on that, like a syndication also is, one thing you want to be clear on is the time period. Typically, ours are, we say, 5 years is what we're looking for. There's flexibility if the market's extremely hot, and we've done this before. We've exited early because it was the best time to exit. On the opposite side of that is at 5 years down the road, it's not a closed-end fund that we have to unwind on December 31st of any given year. We can look at the market. If the market's depressed, it's still cash flowing, we can hold another year, let it come back, and sell to maximize gains for the limited partners and ourselves. So but the point there is it's not a liquid asset. So when you go into that, have the time horizon that matches what they're offering. So make sure your expectations and what they're offering line up, so there's no confusion on that. And then a PPM must be prepared by an attorney that specializes in being compliant with the SEC rules, which we have highly specialized attorneys we use for preparing these documents. All right.
Okay. So what can you expect? Just say you learn about in one of these opportunities on apartment syndication. What can you expect? Bill and I very clearly take it up front to say that, listen, we know investors want to hear about two things. They want to know what's in it for them, and how do they get their money back? When do they get their money back? Well, again, let's just break that down for a second. What's in it for me? Well, again, obviously, you invest money to make a return, to earn interest on that money. So that's the part we call it out. We recognize it's super important to the investors. They want to hear about that. Give me the elevator pitch. Well, we want to make sure we touch that that it's this level of return for an expected involvement of X years or X months or whatever it is. And in our case, as Bill indicated, we're typically setting the expectation of a 5-year investment for when we do an apartment syndication. But again, we want to make sure we hit those items right up front and explain to the potential investor, when we're presenting an opportunity to invest with us, that let's cover this right away. So a lot of the times that again, as Corey mentioned earlier, each deal is different, and each opportunity is a little bit different, and the returns may change a little bit here and there, depend upon the market conditions. But again, typically what an investor might expect when they invest with us is something on the order of a 7% preferred rate of return. and you invest $100,000, that's a 7% return. You know, in our typical structure, we'll pay monthly distributions. So you take that 7% divided by 12 months, and you figure out that's their cash flow per year. Per month. When the property is producing excess cash flow over and above the ability, you know, again, we run our budgets, we set our numbers to be able to run the property, to run the, make sure we're taking care of the property, make sure we're properly maintaining the property. And then we obviously have to pay the mortgage taxes and you know, things like that. You know, but again, we obviously make sure we're budgeting enough cash flow to make sure we're paying the investors. When we have cash flow that goes above that, we had a great month, we will take 70% of that additional funding and return that to the investors. So again, it's a passive investment, and when you invest, you're investing as a limited partner in these deals. So in that case of the excess cash flow, 70% of the excess cash flow goes to the limited partners, and the other 30% goes to the general partners. Now, again, I want to point this out. You know, we don't get paid until the investors paid as the general partners. You know, we call that alignment of interest. You know, we want to make sure we're taking care of the investors and providing a return on capital, you know, for the investment that the investors made. And then we want to make sure we're giving them the icing on top of the cake. That, you know, the reason they got involved in the project is to earn additional upside. And again, after that, you know, when the property earns more, the investors get paid more, and that's when the general partnership team gets paid as well. And then at the end, number 3, at the end of the investment, when the property is sold or whatever happens, typically it's a sale. You know, we obviously have to pay off the mortgage, you pay the sales costs and things like that. But again, there's going to be additional money that's left over at that point, is expecting that the investment did well. You know, hopefully you've driven the, you know, the value of the property up significantly by increasing the net operating income. You know, that's what we work on every day, is finding ways to increase the net operating income that the property is making. And again, that is revenue minus expenses. That's the net operating income. You know, so that's our job, is to focus and look for ways to improve the net operating income of the property, and that makes the property worth more. And again, back to the private placement memorandum, the PPM, that has all the specifics about how the earnout is paid and things like that. And again, you know, we take care of the investors. We've improved the property. You know, so our goal at Park Capital Partners is to do 2 things: make our investors money, and to improve the property so that when we sell the property, it was better than when we bought it. You know, we recognize absolutely that we're taking care of the investors, but at the same point in time, we're providing a nice place for the residents to live. You know, this is their home, so we want to do a good job and make sure we're taking care of the property, keeping up that preventative maintenance, improving the property, adding amenities, adding things that make it a nicer place to live. And again, all of that serves to help improve the value of the property, increase the, you know, so that when we sell it for, you know, a good bit more than we bought it for. You know, that's our value add model approach that we talked about. And in doing so, you know, we have made profit, and we take that profit and we again split it out based upon the defined waterfall structures. And really what that just means is there are different levels how the investment pays out. But again, you know, we pay the sales costs, we pay off the mortgage, and then we pay the investors, and then we pay the general partnership team for all of the work that we've done together to make that property a better place. Okay.
Yep. And just last thing to add on that is just a simple deal that Richard said, that you know, the disposition phase of it, we typically look, when we're going to a deal, when Richard and I evaluate them and to see what deal would make sense, that, you know, depends on the price we can pay for it and everything else as far as the returns, kind of back into it. We look for typically around an equity multiplier 2.0. So in other words, if you put $100,000 in, when you take in your current pref payments, your over pref, and the back end splits through the waterfall, it basically would double your money over that 5-year hold. So something, you know, 15 to 18% annualized return is kind of the typical projects we're looking at.
Corey, sound like there's a question? Yeah, please.
Yep. Excuse me. So the first question: what is the minimum investment to enter a similar deal? I know in my example, I used $50,000 because I see that on a lot of syndicator paperwork as a minimum. I know Richard in this slide has referred to a $100,000 threshold, maybe not giving away what Park Capital's standard is, but on average, just as syndicators, what do you guys see as a standard minimum, and what is that to be said about the deal in question if it's, a lower threshold versus a higher one? Can you speak to that effect with your expertise, please?
Yeah, absolutely. Typically, we do see ourselves. Typically, it's a $50,000 minimum that is out there as the usual entry point. And again, hopefully everybody has more than that in their self-directed IRA accounts and things like that. But again, when you're doing as Bill illustrated the example earlier, if you're doing a $60 million project, you might need to raise $20 million in equity, and so we find that 50,000 is usually the right number. It depending upon the investment and the opportunity, there could be a higher threshold. I mentioned 100,000 just to keep the math simple earlier. But again, somewhere in that 50,000 is usually about right what we see. Was there a second part to the question, Corey?
There was a few other questions, but that answered that one fully. Thank you. The next question, and I believe you did answer it within the last slide, but I'll just reiterate it for good measure. Do you pay preferred returns before paying out the general partners? And then a second leg to that question, how much are the general partners typically investing?
Yes, we do pay the LP investors before the general partners. Yes, and typically the general partners may have up to 10% in the deal. It depends upon the size of the deal, and each deal is different. But again, I want to emphasize the point that Bill and I invest our own money in the deal. Absolutely, every single one of the deals. And if there's somebody else that's on the general partnership team with us, they invest their money as well. But again, we believe that we take the position that says put your money where your mouth is. So we absolutely put our money in because we want to help build the investor confidence that we're in the deal too.
Mm-hmm. And that money, just to be clear, like Richard said, we invest our money. That sits right next to the LP money. It's paid out pari passu with them. There's no difference to our money or theirs. So we are the general partner fee, as Richard said, after we have satisfied all the limited partner returns, and that's where our money sits that we invest as well.
Right.
All right, thank you, gentlemen. And one final question before we move on is, as an investor, do we have access to the financial data, or what is the information given for the profit loss numbers at the end?
Yes, I'll take it real quick. That's actually on our next slide. We get in what to look for in a sponsor. Perfect. We'll definitely cover how we disseminate information to the investors.
Okay, well, feel free to jump onto the next slide. I'll keep monitoring the questions. Everyone, participation-wise, feel free to continue to add in questions. I think it's making this a great presentation so far. So, guys, feel free to move on to the next one. And if you're answering them naturally, I'll just disregard those.
All good. Thank you, Corey. And again, appreciate you keeping an eye on the chat box for the questions.
Okay, so yeah, what to look for in a sponsor. So we want to, as sponsors, Richard, we want to set expectations on, what our communication, what the project's going to do, what our business plan is. All that's typically spelled out, or is spelled in our case, is spelled out in the offering memorandum or the investor summary that we send to investors ahead of the deal. So they'll get to see, there's 200 units, there's 180 of them that are classic units that need to be renovated. We've set aside $7,500 per unit for renovations. We think that increases the rent $125 per unit. It's still below the comps next door. All that goes into the business plan, and then they can vet that. We can show them what the other rental are, what the recent sales have been, why our business plan makes sense, and that's, we want to set that expectation and make it a reasonable, conservative expectation going in. And then we also the conservative approach. Most everybody says they do a conservative approach. We've seen variations of that in different OMs, but what we're saying here is an expansion of the cap rate. So the cap rate to price has an inverse correlation, where as the cap rate expands, price goes down, and then of course the inverse happens on the other way. So if you're buying something, say at a 5 cap, you want to write for an expansion on the exit. So 5 years down the line, we're going to say the market's not as good as it is today. We typically build in 10 basis points per year of hold. So on a 5-year hold, we'd have a 50 basis points expansion typically. Some that'll vary on submarkets and whatnot, but that's typically where we like to write to. So the projection, if we're saying you're gonna get, we're projecting on our pro forma that the project's gonna return, 17% at a 5.5 exit. If it doesn't expand to 5.5, if it stays where we currently bought it, say at a 5 cap, the rates will be much better. The returns will be much better. I'm sorry, the returns will be much better. So you want to make sure you build that in there. It shows some conservatism. We don't know what's going to happen in the future, so we have some expansion in there. What you don't want to see is somebody having a compressed cap saying like, hey, it's 5% now. We think it's going to keep getting tighter, and we're going to show an exit here at 4.5. That's unrealistic that's very aggressive, we would say. And even holding the same is fairly aggressive. Like I said, if it holds true, it's only an upside to the team and to the project, but we want to mitigate the downside risk. And then you want to see they have a track record of success. You can type in anything into formulas, you can put anything on paper, but you want to actually see that the pro forma that they initially came out with actually proved out to be. And things will change. I mean, COVID, nobody predicted that, of course, but there are other things will change, but you still want to see that'll prove for the most part that how conservative that was underwritten, right? If all their deals have not lived up to the pro forma, then that shows a pattern also. If the deals have beaten the pro forma, that's another way to look at it too. So you just want to make sure they have a track record that they have done this before, they've closed deals, and they've gone full cycle on deals, and preferably more than one. So you can check against what they originally underwrote and what they actually turned out to the investors. And then to the investors, the conveniences, we want to make it as streamlined as possible. So we have electronic signatures, we have automatic deposits, confidential treatment of their sensitive data. So all that it just makes it a smoother process. We have an investor portal on our website, for instance. They can go in there anytime and see the returns, how each project's performing, all that, just to try to make things, again, more transparent and also streamlined. And then to your earlier question, Corey, the form there that effective communication. Richard and I are big believers in that at Park Capital Partners, that we put out a monthly newsletter, and then we also quarterly do a webinar. And then we also, at the end of the financials, I think there was a question earlier. So every month we put out a newsletter, like, here's what's happening on the property, here's what we've completed in the last month, the number of units we've done, what are the improvements we made at the property. And then quarterly, in addition to that newsletter, we attach the rent roll and the T12, which the T12 is a trailing 12, so it's the financial snapshot. So you see all the income, you see all the expenses, and then you see your net operating income. So the investors can track that along with us. We send it out quarterly, but it shows the quarters that it wasn't sent out. So they can see this full transparency. They can see where the money's coming in, where it's being spent, and how we're driving the NOI each quarter. So I think that answers the question on the availability to see that. It's always available, and we're always available to take calls in between that quarterly update. We're more than happy to talk with any investors. And then integrity and transparency, that kind of leads to what we were just saying about we share the rent roll, we share the T12s, webinars, monthly newsletters. We want to stay in communication, and we don't want anybody wondering what's happening with their project. So we think it's paramount to stay on top of that, and we take pride in being transparent and having good communication with our partners in the deals.
Corey, any more questions there?
Yeah, actually, there are two new questions. One just popped up as well as I was saying that. Excuse me. So this question, I don't know that necessarily has happened to Park Capital Partners, but maybe you guys can speak on it. What happens if you're unable to raise money and you have a deal on hand? Is that a scenario you guys have ever seen or would understand and be able to articulate how that would work out in that case?
So that has not happened to us, short answer. But then secondly, I think what you're saying is that, if an investor puts money up front in a deal that was planned that doesn't happen, what happens to that investor money? Well, the money would be returned. Again, that's never happened to us. We've been able to, complete every deal we've ever put under contract. I think that we always take the approach that, listen, these are great opportunities. Investors are interested and want to be part of these types of deals. but again, an investor has to know about the opportunity before they can invest in it. So we obviously try to do a good job of letting folks know what we do, and that type of thing. But again, that's that worst case scenario is something I wouldn't want to have to deal with. But again, the investor, of course, would get their money back.
Right. And just to add to that, Richard, there's two ways that can happen, I think, Corey, that as Richard said, one was the fail, say that the team needed to raise $15 million and they came up short for whatever reason, and then they fall out of contract. The money that was wired in would have to be returned. Absolutely. The other scenario would be nothing to do with that. You raised all $15 million. And then as you go through all the inspection period, we have the first 30 days of due diligence. Say the environmentals come back, they have to do a phase 2 environmental, and then it was contaminated, and all of a sudden it falls out of contract for something not related to anything on our side. The seller's at fault. The seller would have to, cure that, and all the money be returned in that case as well. So there's a scenario that everything looks good, but for some reason, like it fails on inspection, like environmental, for instance. That's another example where money could be returned through no fault of the sponsor or anything as well. Neither one has happened to us, but that was just another example.
Right.
Perfect. Thank you, gentlemen. And then another question real quick. Between the managing partners, do you have a loan guarantor status? I'm not familiar with that question, so maybe if you could explain what that means, the loan guarantor status, and then just the answer in itself.
Yes, sure. So Bill and I, as general partners, we are called when you're doing a project like this, there's a couple of terms in there. So one of them is key principle, of which both Bill and I are, and that means that we've done these deals before. We've been successful at doing these deals, and we've gone through the process of putting them together, et cetera. And that also it basically means that we've had the experience of raising the money, of being on the loans and things like that, and we've done the loans with in the agency's eyes, agencies being Fannie Mae, Freddie Mac, that type of thing. So. But at the same point in time, there's another term that was mentioned called loan guarantor. We do these large loans that are non-recourse loans, non-recourse absolutely to the LP investor. The LP investor would never be held accountable for the loan. But at the same point in time, we as general partner, we also want to be looking for, and we only do non-recourse loans to us. In that context, both Bill, nevertheless, somebody's name still has to be on the loan. So that's what's called a loan guarantor. So Bill and we do have our names on the loans. Most of our loans are typically Fannie Mae, Freddie Mac loans. So our names are on the loans. But again, they're still non-recourse loans, but they're it's an important part of completing and bringing that deal to market, to the investors, is to obviously have a key principal and to have loan guarantors. So hopefully that answered it. Anything else at the moment?
I'll go ahead with one more at the moment, and then I'll let you guys get on to the next slide.
Sure.
Are deals harder to come by in the current cap compression environment with lower rates and higher levels of interest in the space? And then a sub question to that, have the return metrics changed over recent years?
I would say briefly to the first part of the question that yes, the deals are more competitive these days. There's a lot of interest in the multifamily space. We certainly, as you think about the real estate continuum, there's obviously single family homes, but anything in the commercial side, there's lots of different segments that are out there: office, retail, medical, apartments, things like that. And I think everybody is aware of what's been going on in the market, where retail and office haven't been as strong lately, of course, because of COVID. And I think there's more money that's moved over toward trying to come into this space, into the multifamily space. But we're still seeing lots of deal flow. So what was the second part?
Yes, the second part was, have return metrics changed over recent years?
I would say they have changed slightly. A deal, a couple years ago, you might have seen a slightly higher pref payment. And certainly as the interest rates have gone down and are remaining down, it might be a little harder to achieve some of the higher payouts that you might have seen years ago. So they've changed slightly. but again, we're still seeing, very strong opportunities to achieve, really good returns for the investors. So that's why we do this.
Perfect. Thank you. With that,
Absolutely.
you guys can go ahead and move on to the next slide. I'll kind of read through a few of these questions as they apply.
Yeah, thanks, Corey. Okay, so, and again, we're going to just touch on this briefly. These are our success stories. Success stories meaning these are deals that we put together a syndication, put together a project with a group of investors to buy these different 3 assets, and we were able to achieve strong results in all cases. Top one, Windward Forest, is Atlanta, Georgia Metro. It was a property that we saw as definitely an opportunity to really improve the property and improve the operations, and we were able to do so. We planned on, again, hopefully everybody knows the term IRR, internal rate of return, but the thing that's maybe more relevant is average annual return. We planned on an average annual return on that project over a 5-year period of 20%, and in 2 years we were able to beat that projected return of 23.9% actual average annual return. And we put $1 million capex into that property. It was a property that we saw and that needed some love and needed to be improved in terms of its operations, and again, for that purpose of generating investor returns and providing a nice place for the residents to live, and we were able to do that. The next one was in Norcross, Georgia, a property called Legacy Norcross. We had planned on the average annual return over the life of the project to be 18.9, and we achieved a 25.4. And again, the opportunity was there. The market got hot again. We spent a significant amount of capital on the property. We were able to improve the rents by renovating units and move the rents up a good bit, therefore increasing the net operating net operating income, and in doing so, that's why the property became more valuable. The third one, the Legacy Lanier up in Gainesville, Georgia. Again, similar approach. We anticipated a 18.9 average annual return, and we beat the 25.4. Again, we put capex into the place. When we found that property, it was actually kind of a shame. It was the middle of the summer in Atlanta, and about 10 of the units did not have air conditioning, which was awful. And same point in time, the pool wasn't operating in the middle of the summer in Atlanta. So we obviously held the seller accountable for fixing those immediate problems, and they did so. But then again, you have to maintain and do preventative maintenance going forward. But again, we were able to do a great job for the investors, returning higher than planned returns, as well as making the places nicer places to live. So, Bill, anything to add on this?
Yeah, just on the, if anybody's looking at Legacy Norcross and Legacy Lanier there, the reason that we have the exact same planned IRR and the same annualized return was they were bought as a portfolio. So we bought them, they're different properties, but bought them as a portfolio the same days. Why we had a kind of a fund model as they went in. So that's why they have the same projected returns on them. I just wanted to call that out so it wasn't looked a little odd on the numbers.
Right. Yeah, well said. Thank you, Bill.
And gentlemen, I've seen your detailed breakout of the legacy investment within your own channel and platform that you guys present on. Is that something, if anyone were interested, that they could access? And if so, can you direct them how to get to that through either your website or wherever you may have that hosted?
Yeah, we may be able to make some information available to investors. So, there are some things, of course, about any deal that are going to be confidential that can really only be shared with people that were in the deal. But I understand the question, and certainly we'll make some information available if anybody would like to certainly follow up with us. And
Yeah.
maybe I'll go ahead and put our contact information up. Please anybody, sorry, Corey, didn't mean to talk over you there, but please anybody, certainly feel free to reach out to Bill and myself. There are our email addresses and our mobile numbers. We're happy to speak with anybody that would like some more information, that kind of thing.
Yeah, all I was mentioning to that effect was that presentation. I believe it was through your own group that I mentioned earlier that I participate in. It was such a beautiful presentation and such a great outlook on a successful project. So I just wanted to, give you guys the plug per se. of letting people know if they can access that, where to find it. So that I completely understand. I was just trying to help out to that effect.
No, appreciate it. Absolutely. Yeah.
Yeah.
And again, there's certainly some information we can share. Yes.
So
Yeah, well,
at this time, we've got Bill and Richard and also their associate Frank's contact information on the screen here. I'm going to look through these last few questions that have come in. I know that we have a hard deadline here to get wrapped up at 1 p.m. Eastern time. So let's just go over, let's say, 1 or 2 questions, and then we'll let Bill and Richard go. And again, this session will be recorded. If you are interested in a copy of the slide decks, you can reach out to myself via email, and I can forward those to you. My email is cdaharsh, DAHARSH, @advantaira.com. And feel free to take down Bill and Richard's contact info and reach out to them. If you have any questions about Park Capital Partners specifically, or any of the information that they've conveyed today, thank you both, gentlemen, for your time and your efforts in educating on syndication investments. Very much appreciated.
Cory, it was our pleasure. Absolutely. We appreciate your inviting us. And again, thank you to your audience who joined us today.
Yeah, thanks, Cory, and thanks everyone for joining. Like I said, as Cory and Richard said, if there's anything we can do, please feel free to reach out, and we're always love to talk about real estate. So we appreciate your time.
So I'm looking at the questions here. A few of them are just asking for copies of the slides, which I've tried to reply to directly. And then a few individuals have been asking specifics on Park Capital Partners, like your deal history and things like that. Anytime I've seen one of those, I've tried to implore those individuals to reach you guys directly, again, with your contact information here. I don't think that's appropriate to share the answers to those questions or respond to those questions on this session. Those are things that you should definitely reach out to Richard and Bill and ask directly in a more one-on-one capacity and scenario.
Absolutely, please do. Happy to follow up with you. So thank you, Cory, for that the pointer. And again, folks, please do reach out. We'll be happy to have further discussion.
All right, perfect. Well, with that being said, I'm going to let you guys go here right at 1 o'clock sharp. I hope you have a great rest of your day. Again, the recording will be emailed out about this time tomorrow. And if anyone is interested in a PDF version of the slide deck of the slides that were presented today, feel free to reach out to me directly and I will be happy to pass that along. Thank you so much for your time today. Bill, Richard, again, very, very much appreciated. Always great knowledge coming from you guys and Park Capital Partners. And I hope everyone has a great rest of your day.
Great. Thanks, Cory. Really appreciate it.